The fundamental equation, action equals volume liquidity, forms the cornerstone of MetaQuant's approach. It represents the dynamic relationship between transaction volume and liquidity available in the order book, and its interpretation is crucial for understanding price movements in financial markets. In this equation, volume refers to the quantity of transactions executed in a given market within a specific time frame. It represents the effective demand, measured in terms of the number of contracts or units exchanged. Volume serves as the driving force behind price fluctuations, as it reflects the activity of market participants and their interest in a particular financial asset. On the other hand, liquidity denotes the amount of available liquidity in the order book at a given price level. Liquidity consists of buy orders at the bid level and sell orders at the ask level present in the market. It represents the market participants' ability to execute transactions without causing significant price movements. Higher liquidity means that larger volumes can be absorbed without causing substantial price deviations. The equation, action equals volume liquidity, establishes an inequality relationship between volume and liquidity. It indicates that when transaction volume exceeds available liquidity, significant actions occur in the market, leading to price movements. This inequality can be interpreted in various ways, depending on the market context. If the volume of buying surpasses the liquidity of selling, volume liquidity, it creates upward pressure on prices. Buyers compete to execute their transactions, which can result in price increases as demand exceeds supply. Conversely, if the volume of selling exceeds the liquidity of buying, volume liquidity, it creates downward pressure on prices. Sellers dominate the market, seeking to execute their transactions, which can lead to price decreases as supply exceeds demand. The equation, action equals volume liquidity, highlights the importance of monitoring the interaction between transaction volume and market liquidity. Traders and analysts use this relationship to anticipate potential price movements and make informed decisions. For example, a sudden increase in volume with limited liquidity may indicate an imminent price reaction, while low volume with abundant liquidity may suggest a period of consolidation or price stability. MetaQuant utilizes this fundamental equation as a guide for analyzing and interpreting order book data. By visualizing and studying variations in volume and liquidity, traders can seek signals to enter the market, identify key support and resistance levels, and anticipate potential trend reversals. Understanding the dynamics of volume and liquidity is crucial in trading and investment strategies. When volume surpasses liquidity, it indicates an imbalance in supply and demand, which can lead to significant price movements. Traders often look for opportunities where there is a substantial increase in volume relative to available liquidity, as it may signal a potential price breakout or trend continuation. Moreover, the relationship between volume and liquidity is closely intertwined with market psychology and sentiment. When volume is high and liquidity is scarce, it may indicate heightened market enthusiasm or fear, potentially leading to exaggerated price movements. Conversely, when volume is low and liquidity is abundant, it may suggest a lack of market interest or indecision, resulting in limited price fluctuations. It's important to note that volume and liquidity are not the sole factors driving price action. Market participants' behavior, news events, economic indicators, and other fundamental and technical factors also influence price movements. However, the volume-liquidity relationship provides valuable insights into the dynamics of supply and demand within the market. In summary, the equation, action equals volume liquidity, serves as the foundation for MetaQuant's approach to market analysis. By understanding and applying this fundamental relationship, traders can enhance their understanding of price movements and make more informed trading decisions. Monitoring the interplay between volume and liquidity allows traders to identify potential trading opportunities, assess market sentiment, and anticipate trend reversals. Ultimately, the equation highlights the importance of volume and liquidity dynamics in the financial markets and their impact on price action. Let's now talk about the famous equation offered by Philippe Bouchaud. The equation proposed by Philippe Bouchaud, which describes the impact of volume on price volatility as a square root function, is an intriguing concept that provides valuable insights into the dynamics of financial markets. By understanding this relationship, traders and investors can gain a deeper understanding of how volume influences price movements and adjust their strategies accordingly. In this detailed explanation, we will explore the equation in depth, highlighting its technical aspects, its significance in market analysis, and how MetaQuant, a powerful tool, facilitates the measurement of volume's impact on prices. Volume plays a crucial role in financial markets, representing the number of shares, contracts, or units traded during a given period. It is an essential indicator of market activity, reflecting the level of participation and liquidity. When volume increases, it often signifies heightened interest and potentially greater price fluctuations. The equation, which states that the impact of volume on price volatility is proportional to the square root of the traded volume, can be expressed as follows. Impact on price volatility equals square root volume. This relationship suggests that as the traded volume increases, the impact on price volatility also increases, but at a diminishing rate. The square root function indicates a nonlinear relationship between volume and volatility. It implies that larger volumes have a relatively smaller impact on volatility compared to smaller volumes. The concept of the square root function stems from the idea of diminishing marginal impact. It suggests that as volume increases, the incremental effect on price volatility diminishes. For example, doubling the volume does not lead to a doubling of price volatility, but rather a smaller increase in volatility. This nonlinear relationship is observed in various financial markets and is supported by empirical evidence. Now, let's delve into the technical aspects of the equation and its implications for market analysis. MetaQuant, a powerful tool that combines advanced analytics and real-time data, enables traders and investors to measure the impact of volume on prices accurately. MetaQuant operates through a web browser like Google Chrome or Firefox, utilizing technologies such as WebGL, TeachReJS, and JavaScript to provide a seamless user experience. One of the key features of MetaQuant is its ability to connect to the market data via integrated WebSockets, receiving real-time updates on volume and price movements. By visualizing the order book and market depth in a 3D/4D scene, traders can analyze the interplay between volume and price action. MetaQuant's sophisticated algorithms enable users to interact with the order book, identify liquidity levels, and anticipate potential price movements. MetaQuant employs a degraded thin heat map style, which allows for clear visualization of volume and liquidity levels. Traders can customize the display settings, adjusting the refresh rate, speed, and scale for a comprehensive analysis. The tool also incorporates AR/VR interactions, enhancing the user experience and providing a deeper understanding of volume's impact on prices. By using MetaQuant, traders can monitor the incoming and outgoing volume in the order book and identify the liquidity available at different price levels. This information is crucial for assessing market sentiment and anticipating potential trend reversals. MetaQuant's advanced analytics and visualizations enable users to make more informed trading decisions based on volume's impact on price volatility. Furthermore, MetaQuant provides a platform for analyzing and processing order book data, bridging the gap between technical analysis and market dynamics. It allows traders to collect, process, and analyze a wealth of data, transforming them into actionable insights. By integrating the order book data with other market indicators and tools, MetaQuant empowers traders to develop comprehensive trading strategies and capitalize on market opportunities. Now, let's further explore the implications of the equation and its significance in market analysis. The square root relationship between volume and price volatility suggests that larger volumes have a diminishing impact on volatility. This implies that as volume increases, the potential for extreme price movements decreases. It provides a measure of stability in the market, indicating that larger volumes are required to generate significant price changes. Understanding this relationship is crucial for risk management and trade execution. Traders can adjust their position sizes and risk parameters based on the expected impact of volume on price volatility. By incorporating this knowledge into their trading strategies, traders can better navigate market conditions and optimize their risk-reward profiles. Moreover, the equation SK